What's up, you guys? I'm Dan. This is Frugal Not Cheap. This week we're diving into a significant policy change from the White House, Trump's executive order bringing alternative assets like crypto, real estate, private equity into everyday 401k plans. This sounds exciting and is billed as democratizing access to assets that some of the big institutions have access to, but individual investors have not, at least through their employer-directed plans, self-directed employer plans. But as someone who strongly believes in the power of low-cost index funds, I see some potential risks for the average saver. In this video, I'll break down what's going on, what are the promised benefits, and why I think simplicity and low fees are in the long run going to generally be the better bet for most people. So this actually all started almost a year ago, in August of 2025, when President signed Executive Order 14330. It was titled Democratizing Access to Alternative Assets for 401k investors. What it does is it directs the Department of Labor to make it easier for 401k plans to include alternative assets like private equity, private credit, real estate, including debt, infrastructure, commodities, and even actively managed crypto. The idea here is to give workers access to the same assets that public pensions and wealthy investors have had access to, that has helped to give them more diversification and potentially higher returns. Since then, the Department of Labor has issued proposed rules to create a process-based safe harbor for fiduciaries, but this rule is still proposed. In fact, as of this filming in June 2026, the public comment period had just closed earlier in the month. Okay, so what's the idea with this? I mentioned diversification a little bit ago. So proponents of this would argue that adding a small allocation, so we're not talking about the whole portfolio, but a relatively small allocation to these alternative assets, because they're not positively correlated so much with other assets, they could improve long-term risk-adjusted returns. And in theory, more choice and diversification should be good, kind of, on its face. However, when looking at this for sort of the everyday investor, we're starting from a place where really a lot of 401k plans have been pretty good at pushing low-cost index funds, which I'm a proponent of, and have done really, really well for a lot of people, including myself. Now, obviously, yeah, sometimes they still push actively managed funds and overly complex portfolios and what have you. But at the same time, Vanguard and the others have done a really good job of making those low-cost index funds and target date funds especially readily available. Against that backdrop, kind of what's going to happen if we add in these, these alternatives, access to these alternatives for most people? Well, there are actually four main concerns. The first one is going to be that these alternative assets may engender high fees. So for instance, private equity charges a 2% management fee plus takes 20% of profits. And there can be other fee layers when packaging these things into 401ks. Meanwhile, a lot of the low-cost index funds can have expense ratios of just 0.03%, and on the higher end, maybe 0.1%. That's still 1/10 of 1 percentage point, which is fantastic. And these fees can make a huge difference over time, as any fees compound their impact over time. So just as amazing as compound interest is in having your assets grow over time, the same thing is happening with those fees, where the longer and longer you're eating those fees, or those fees are eating into your portfolio, the more and more they're taking away from gains that you could have had yourself. The second problem is the problem of illiquidity and valuation. So these private assets can be difficult to sell exactly when you want to. And so famously in a lot of the private equity type stuff, it's really hard to tell exactly how much the assets really are valued at. And that's kind of on purpose. There can also be some subjectivity about these valuations when there aren't active trades going on back and forth. So this kind of thing where, there could be a long delay before the assets are actually marked to the market, whenever that might happen, isn't exactly ideal for retirement accounts. The third issue is really that we're adding a lot of complexity here and some added risk as well. So when we start looking at these alternative asset classes, we can see much higher volatility, especially when we talk about crypto, than most investors are used to. So, even when we look at, your run-of-the-mill investments, Generally, these plans have you do kind of a risk assessment to see how much you should have in bonds to be more conservative, how much you should have in equities, which are going to be riskier, but and have more swings, but also generally bring higher returns over the long run. Well, then crypto, assets can be just hugely volatile and really are kind of like a different animal compared to those things. Now, I wish that every single 401k investor was super informed and educationally set and had a very strong financial education and knew exactly what their risk tolerance was and had an investment philosophy or investment thesis and built their portfolio accordingly and understood portfolio theory. But that's just not the case. And so knowing that, there's a little bit of this kind of nanny state kind of idea here, unfortunately. But maybe it's not the greatest idea to sort of make it possible for 401k participants to put 90% of their assets in alternative assets rather than in target date funds or something like that. So the Department of Labor itself has actually urged that we should take some extreme caution regarding this kind of stuff. And then finally, the fourth reason, and this is really the kind of important, is sort of net performance. Because again, we're trying to get risk-adjusted returns, increased risk-adjusted returns, and that might be true if investors are able to really keep it down to a small proportion of the portfolio that helps to have some uncorrelated movements when the stock market's coming down, these might go up, that kind of thing. But the problem is, once you really account for all of the expenses that are involved, that illiquidity in its own can also bring more expense, these wider spreads and that kind of thing, then the data really doesn't show that these alternative strategies can consistently outperform simple low-cost index funds. So, at least for me, I'll be continuing to do what I always did, which follows along with John, or Jack, as some called him, Bogle's philosophy. He's the guy that started at Vanguard and really led up the index funds. His lesson was that we shouldn't try to beat the market. Instead, we should try to own the entire market at the lowest possible cost. Over many decades, this has borne out to be a very effective wealth building strategy. So what would I do if I was just starting out with my 401k? And of course, this is again, not personalized financial advice or anything like that. I'm just talking about my own situation. But I would do one of those risk questionnaires and kind of figure out what my risk profile looks like, what my risk tolerance is. I would build a portfolio that matches that risk tolerance it was basically made up of low-cost index funds. So I'd be looking at low-cost bond indexes, both domestic and international. And then also low-cost stock market indexes, both U.S. and international. And I could, of course, get all this done generally with a target date fund as well. That could be a good option. And then once I had that set up, then I would make sure that I'm definitely taking advantage of any kind of employer match, because that, of course, is 100% return on the investment, so that's pretty awesome. And rather than messing around with illiquid or risky or crazy assets, I would focus on my savings rate and trying to put in as much as is appropriate into that 401k as possible. Would I personally put a small allocation, just a few percent, into these alternative assets? I think probably not. And in fact, no, I'm not going to do that with my current portfolio either. What do you think? Would you consider alternative assets in your 401k? Why or why not? Let us know in the comments below. I hope you enjoyed the video and found it helpful. If you did, please hit the like button and consider subscribing. Also, there's a bunch of referral links in the description for the video. If any of those are useful to you, that's great. If not, that's okay too. Thank you very much for watching, and I'll see you in the next video.